What the heck is a MEC? And what does it mean for IBC? Well, first, I'll give you the simplest bottom line answer, and then I'll explain it a little deeper, along with how it does and does not affect your infinite banking account. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. If you find this to be helpful, please hit the like button for this video and subscribe to this channel and share it with your friends and family. Also, please post your questions and comments here. You have questions, we have answers. Okay, so the simplest bottom line explanation is this: MEC, that is MEC, stands for Modified Endowment Contract. That's what the IRS calls a cash value life insurance policy that has had too much money paid into it. And because cash value life insurance profits from the greatest benefit in the IRS code, that is growing tax-free, and the withdrawals are on a FIFO, or first in, first out basis, which means that you can withdraw from the cash value up to the cost basis without any tax liability. And you may take policy loans without triggering a taxable event. So tax-free loans. And because cash value life insurance, especially participating whole life policies, pay the greatest compounding dividend interest to the cash value of the policies. That means the IRS does not benefit from all those gains that you make. In fact, that's the reason why prior to 1988, single premium whole life policies were so popular with the wealthy and those wanting to shelter and grow their money safely. So the IRS stepped in and created the MEC. Again, a whole life policy will become a MEC when too much money is paid into the cash value of the policy. So, what constitutes too much money? And how does this name change affect infinite banking strategies? The IRS decided that when the amount of money paid into the policy over the first 7-year period equals or exceeds the amount of premiums that would pay for the policy in full for those 7 years, that's too much. Then the 7-year rule starts all over again for the next 7 years. That's called the 7-year test or 7-year rule. So that amount is determined by the face value of the policy and the amount of premium required for that policy. So face value or death benefit, and amount of premium required for that policy. Now, what happens when a life insurance policy becomes a MEC, modified endowment contract? The main change is that the gains in the cash value due to the compounding dividend interest become a taxable thing as regular income if you withdraw or surrender any of it, because it then changes from FIFO, first in, first out, to FILO, or first in, last out. The worst part is that then policy loans are treated as taxable income. And that's a total bummer for infinite banking. As you know, the best part of infinite banking, and the reason we use the cash value of participating whole life for it, is the tax-free growth, and that you can take policy loans without interrupting the compounding growth of the account and the loans are tax-free as well. Another thing that happens when a life policy becomes a modified endowment contract is that you could become liable not only for the tax on the money taken or leveraged from your policy, but you could even also get hit with tax penalties for early withdrawals, as if it were a retirement annuity account. And I'm referring here to the age 59 and a half rule for retirement account distributions. One thing that doesn't change with a MEC is that it is still a life insurance policy, and the death benefit or face value of the policy will be paid to the beneficiaries tax-free. So it's not entirely a bad thing if your only objective for your policy is to pass on wealth from you to your heirs. But if you want to use the infinite banking strategies, you'll want to avoid causing your life policy from becoming a modified endowment contract or MEC. Now, here's another way to look at the 7-pay rule. As long as the cash value of your account stays lower than the death benefit by a certain margin, again, determined by the IRS, and referred to as a corridor, it will become a MEC. If the corridor gets too narrow, it will MEC. And if, of course, there are a couple of ways to increase the corridor and avoid MECing your account. Adding paid up additions is one way, and that'll add to the death benefit and thereby widen the corridor a small amount. Again, we need to keep the premium, including the paid up additions, below the MEC limit for the year. Another way to increase the MEC limit is to build the policy with a term rider. That will increase the death benefit at a lower premium requirement. That impacts the MEC parameters by both increasing the death benefit and lowering the premium requirement for the total amount of insurance. Well, there is an actual mathematical formula used to determine what the MEC limit is for any particular policy. That inputs to that formula varies with each policy. Fortunately, the insurance company will warn you if your account is in danger of becoming a MEC. And that's a good thing, because we really don't want to lose all those tax benefits that are inherent with whole life insurance policies. And when designed properly for use with the infinite banking strategies, your policy will have the highest MEC limit possible for your specific policy. And that will allow you the option to infuse your cash value with greater amounts of cash, which will then add to the compounding gains. Of course, there are rules and guidelines on how you can do this, that is, add to your cash value. And that's the subject of another video right here on this channel. So if you found this to be helpful, please hit that like button for this video and subscribe to this channel and share it with your family and friends, please. Also, post your questions and comments here. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below the video here. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also here. The link to buy my books on Amazon.com is also below in the description box. And if you'd like to apply to become a client of ours, the link to that application is also below. We're here to help, and we look forward to helping you. So for now, aloha and mahalo for watching.